Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Louis, and I'm excited to share today's top stories with you. We've got a packed show for you today, but first, let's take a look at some of the biggest headlines from the financial sector. Wells Fargo is in the news again, this time due to a potential settlement with the U.S. Securities and Exchange Commission, SEC, over allegations of misleading investors about its mortgage-backed securities. In other news, Citigroup has reported a significant increase in net new investment assets in its wealth division, with $18.6 billion in the third quarter, up 35% from the same period last year. This represents a sharp turnaround from the previous quarter, which saw an 81% year-over-year decline in net new investment assets. The company's CEO, Jane Fraser, attributes this success to a multi-year strategy aimed at becoming the lead investment advisor for its clients. The wealth division's revenue was up 8% year-over-year, with operating expenses increasing by 4%. Net income surged 32% over the same period last year to $374 million. It's also worth noting that Citi's wealth head, Andy Sieg, has been under scrutiny recently due to allegations of workplace mistreatment. However, CEO Jane Fraser has expressed confidence in Sieg and the findings of an internal investigation. We'll be keeping a close eye on these developments and bringing you more analysis and insights throughout the show. For now, let's take a closer look at what this means for investors and the broader financial landscape. Citi's success in its wealth division is a positive sign for the company, but it's also important to consider the potential risks and challenges that lie ahead. As always, we'll be providing you with balanced and unbiased analysis to help you make informed decisions about your investments. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of high finance, where a recent announcement by JP Chase has sent ripples through the banking sector. CEO Jamie Dimon has raised concerns about the U.S. consumer credit space, likening the discovery of one problem to finding a cockroach, implying that there may be more issues lurking beneath the surface. Now, let's take a closer look at what's happening. JP Chase reported a strong third quarter, with earnings per share of $5.07 on sales of $47.12 billion, beating analyst estimates. However, the bank also took a $107 million impairment charge connected to loans extended to auto lender Tricolor Holdings, which filed for bankruptcy protection last month. Dimon's comments have sparked concerns about the broader U.S. consumer credit market and the potential for similar issues to arise in the future. Some analysts are worried that lax lending standards may have contributed to the problems facing Tricolor and other companies in the auto industry. This has led to questions about whether other major banks may be exposed to similar risks. It's essential to note that JP Chase is not alone in its concerns. The U.S. economy is facing various pressure points, including sticky inflation levels, uncertainty surrounding trade tariffs, and signs of slowing economic growth. These factors, combined with shifting geopolitical dynamics, have created a complex and challenging environment for banks and financial institutions. While it's difficult to predict the exact impact of these developments on the banking sector, it's clear that JP Chase's announcement has sounded a warning bell. As investors and analysts closely watch the situation unfold, it's crucial to remain informed and adapt to changing market conditions. We'll continue to monitor this story and provide updates as more information becomes available. In the meantime, we encourage our listeners to stay vigilant and consider the potential risks and opportunities in the banking sector. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're wrapping up today's show with a look at the latest developments in the banking sector. Several major banks reported their earnings today, giving us a glimpse into the health of the financial industry. First off, JP Morgan Chase beat analysts' estimates for trading and investment banking fees, driven by a pickup in deal-making and underwriting. This is a positive sign for the bank, indicating that businesses are still looking to grow and expand despite economic uncertainty. However, it's worth noting that this growth may not be sustainable in the long term, and investors should keep an eye on the bank's ability to maintain its momentum. Meanwhile, Goldman Sachs Group Inc. posted record third-quarter revenue, but shares were down after the bank reported higher compensation costs and plans for an additional round of job cuts. This mixed bag of news highlights the challenges that banks face in balancing their growth with cost control. While it's great to see Goldman Sachs performing well, the increased compensation costs and layoffs are a reminder that the banking industry is still navigating uncertain waters. Wells Fargo & Co. also made headlines today by raising a key profitability metric after the removal of regulatory restraints it had operated under for more than 7 years. However, this positive development was slightly offset by net interest income that missed analysts' estimates. This serves as a reminder that even when banks are freed from regulatory constraints, they still face challenges in generating revenue and growth. As we analyze these earnings reports, it's essential to take a step back and consider the broader context of the banking industry. While some banks may be performing well, others may be struggling with unique challenges. It's crucial for investors to approach these reports with a critical eye, considering both the positives and negatives before making any investment decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.